On this episode of the AAF Exchange, the debt ceiling showdown, recession watch, and the Supreme Court case on Section 230 protections. Joining us to discuss all of this is AAF's Douglas Holtz-Eakin. Doug, thanks for joining us.
Thanks for having me.
We're back in person. This is a great feeling. I mean, there's not a computer screen dividing us anymore.
Now we're close enough that the antipathy can really flow.
Yeah. It's going to be great. So that's not the only new thing we're doing on this podcast. We're starting this new segment. So before we jump in, we're premiering this new segment where Doug is going to tell us what's on his mind this week. So hopefully it'll only last a minute or less, but we won't cut you off. So Doug, fire away.
This week's puzzle is the economic data. We got data yesterday on retail sales and manufacturing, and the retail sales were the worst of 2022. They were December retail sales, so the holiday season, which is a really important time of the year, and the Empire Manufacturing Index, both were terrible readings, and so made lots of people nervous about the growth in the economy and Wall Street looking for rate cuts. Today we get the labor market data, new claims for unemployment insurance, they fell. So it's looking stronger. And so once again, we're in this situation where you sort of think other things are getting weaker, but the labor market refuses to quit, and we don't know just how strong the growth in the economy really is. Interesting.
Well, I'm sure we'll talk a little bit more about that during our Recession Watch segment, but very good. We will start with the debt ceiling today, though. That seems to be the big news of the week. This week, Secretary Yellen announced that the United States will soon hit the debt limit. I actually think it happened this morning.
As we speak.
We have hit
yes.
Yeah. So we're going to employ those so-called extraordinary measures at this point. So the U.S., doesn't go into that default that we all hear about, and hopefully never experience. But as always, there's a lot of confusion about what breaching the debt limit would actually do. There's many are conflating default with the whole so-called government shutdown stuff that happens. Would you walk us through the basics here?
Yeah, let's talk first about the notion of extraordinary measures. So we're up against the debt limit, and part of the debt that counts toward the limit are investments in government employee pension funds. So you put Treasury securities in there, they earn some return, and that's used to pay future pensions. The most important extraordinary measure is to stop putting the debt in there. In fact, take some out, raid those pension funds. That gives you debt that you can now sell to the public instead and allows us to raise more cash and pay the government's bills. So the extraordinary measures can extend until the X date. That's when you run out of essentially room to raid the pension funds. And that looks to be somewhere in June or August, where the uncertainty is about how much money comes in with the June 15th income tax payments. So they have a quarterly payment on June 15th. You get a lot of cash, you can go longer. So you're going to hear a lot about X dates, extraordinary measures, when does it run out? That's what's going on. At some point, the X date, you've got no more room and you actually cannot raid or otherwise cheat to borrow from the public, and then you're done. And we're running $1 trillion deficits, so you're $1 trillion short. The bills are going to come in. You won't have the $1 trillion. Someone will not get paid. Among the people not getting paid will be those people who have treasuries that are maturing, so they want their interest in their principal. That's called default. And so to fail to raise the debt limit prior to the X date is to guarantee default. One more footnote to this. You will hear about something called prioritization, where Congress might even say top priority is to pay the people who have treasuries. They get their interest and dividends with whatever money you have left over, pay Social Security, and then pay Medicare, and then pay, well, there are two problems with that. Number one, everybody's a priority in their own mind. If you have a contract with the government, you want to be paid. And so you're going to be stiffing somebody, including important political constituencies. Number two, anytime anyone is checked, the Treasury can't do prioritization. It doesn't have the technology to sort the bills coming in into piles, priority 1, priority 2, priority 3. So inevitably, we will fail and we will default on something. So you just don't want to mess with going past the X date. You got to settle things in advance.
Yeah, it sounds like Congress is really going to have their hands full trying to figure this whole thing out. I mean, you have, the new House Republican majority saying they want one thing. The Senate Democrats and the White House obviously want a different thing. I mean, that's going to have to shake out somehow over the next couple of months.
But the one point I want to make always is the one thing they don't disagree about is the need to raise the debt limit. That's not at issue. What's at issue is what goes along with it. And there's a group of Republicans who want that to go with spending cuts. Literally, these are the things we want to cut. Others might go for sort of more modest things, like a promise to examine spending programs. Democrats right now are locked in on a clean debt limit increase, nothing that goes with it. So the disagreement's not about the debt limit. It's just the vehicle to have the fight.
Right. Well, I'm sure we're going to be covering. We will talk about this fight ad nauseum over the next couple of weeks. But for now, let's move on. The economists such as yourself are watching the U.S. for signs of a recession. What is the possibility in your mind of a recession over the next 6 months or 12 months?
I think there's a very high probability of a recession in late 2023. So third or fourth quarter, something mild like a 1% decline in GDP. Looks like it's a high probability, 60% say, something like that, above 50-50. That's because the Fed is in fact tightening as it must to fight inflation. It wants to tighten just enough to fight the inflation but not cause a recession. That's called a soft landing. Historically, anytime the unemployment rate has been below 5 and inflation has been above 4, they have failed to engineer a soft landing. That's exactly where we are. So odds are stacked against them. The procedures they're using are less well tested. They're shrinking the portfolio, which is sucking cash out of financial markets. Never done that before. And they're doing it in an environment where we've got a Ukraine war, and you've got, China, whose future growth is quite uncertain, and the residual impact of the pandemic. So they're doing it in uncertain circumstances. That seems to me to just raise the odds of a policy error, which they will have to undo.
Right. Yeah. I mean, you started mentioning the global economy, which is also showing a lot of mixed signals, too. I mean, you mentioned China, where they're starting to slow down. I think they lost for the first time a significant amount of population. I think that data just came out earlier this week. And we are seeing encouraging signs from countries in Europe. What is your read on the whole global economy?
Well, let's start with Europe. I would have thought that we'd be sitting here in January with Europe in recession, almost certainly. High energy prices, were the key cause of that, and it's not true. We've had a very mild winter. Been a huge blessing for Europe and its demand for natural gas in particular. So those prices remain low. Oil and natural gas prices are not close to what people were afraid of, and we're not sort of using up the growth engine on just keeping the continent warm and running. So good news coming out of Europe. China, tougher. They dropped the zero COVID restrictions, so you can now operate things. On the other hand, they have massive amounts of COVID cases. That's not good for growth. But I think on balance, that's going to be beneficial for overall global growth. They'll grow more rapidly. But what we'll see, the downside is when they grow more rapidly, oil demand goes up, oil prices go up, and we've seen that movie before.
Yeah. Well, anecdotally, I can tell you that it has been a very mild winter because my Pepco bill has actually been very nice this past couple of months, a lot less than I expected.
It's all we worry about, Kyle. So
right.
Your Pepco bill.
Yeah. This really is just about me, right? All right. So at this point, we're gonna preview. We're gonna take a break, and we're gonna do another news segment that we came up with, just to keep things fun and exciting. Called the Fact of the Day Trivia. So as you know, at the top of the dish every week we have the facts of the day. So I'm gonna test your knowledge a little bit on those facts of the day. Last year, federal agencies imposed more than $117 billion in net regulatory costs, making it the 5th most expensive regulatory year since 2005. What year was the most expensive?
First year of the Biden administration.
That's your guess?
Yes.
It was 2012, actually. So it was.
Whoa.
This was back during the Obama administration. It was.
So that was Dodd-Frank, Affordable Care Act, all of that. That was 200 what?
218 billion.
No, it was 201 first year of the Biden administration.
Yeah. So it just barely was below, but it was still a tough.
I'm going to drop the red challenge flag, and let's go back and look at the 2012 data more carefully.
We'll call in Dan Bosch before the podcast's over and get a check on that one. But I'm glad we also got the football chat in there too, because I think Angela was really hoping we wouldn't have any football references in this one. But we can't please everyone.
That was an insurance reference, strictly.
Oh,
that's
right,
all that
was.
That was.
All right, let's end with a discussion of the Supreme Court's case on Section 230 protections. for which the American Action Forum filed an amicus brief.
Yes.
Doug, would you first remind listeners what Section 230 protections do? And second, walk us through AAF's recommendation in the amicus brief.
So Section 230 refers to Section 230 of the Communications Decency Act. And the Communications Decency Act, which dates in 1996, has been called the 26 words that created the internet. And what it does is it says if you're a platform, you cannot be sued for the content that is posted on your site. So if I put up a Yelp review and I say this is a terrible restaurant, the restaurant can't go after the platform for what I said about them. They are held legally harmless for that. That gives them complete freedom to, quote, moderate the content as they see fit. If my review was obscene, they can take it down. If my review was just we didn't have good service, they can leave it there, and no one can contest that. The idea was that if people don't like the way the content's being curated on one site, they can always go to another, and that competition would be beneficial. And that's what the brief is about. The brief is about the economic benefits of Section 230. There are some issues of freedom of speech, First Amendment rights, all of that are going to be in front of the Supreme Court. But they should also remember this has been an important piece of economic policy. We have had dramatic growth in e-commerce and dramatic growth in the internet and streaming services and all sorts of things that benefit from the protections of Section 230. To strike it down would be to put literally a knife in the heart of internet commerce and a lot of the things that people enjoy at the present. So the brief is there to remind them, A, that the facts are on the side of that argument, and B, it's big. These are big numbers.
Mm-hmm. Well, interesting. Yeah, I mean, I know that we obviously that brief is available today, so we can link to it in the show notes of everything.
It will be on the Supreme Court site. It will be on the AAF site, and people can take a look at it. It's very straightforward to read. It's not a complicated argument.
Interesting. Well, Doug, thank you for joining us in our first episode back in the studio. I mean, I'm excited about it. I'm excited that we get to have the face-to-face conversation and talk about all these fun issues.
It's great to be back, and it's just one more thing that we can put in the rearview mirror after the pandemic.
Yeah.
I'm pleased about that.
Amen. So thank you again, Doug, and thank you for everyone that listened today.